Hello, everybody, and welcome to Confident Compounding with Corey Kramer. It's been a while, almost a week. I don't know if I've ever gone that long without making a video when I wasn't on vacation, but it happened, so we're just going to pick up with a buy video, which I haven't had in a while. One of my goals starting, around this summer was to try to give at least one buy video every couple months. Even if, the market's really high and there might not be anything that's like kind of perfect, like back in April of this year, to at least kind of make myself share what I think kind of is the most interesting opportunity, even if it's not kind of perfect. So I think maybe the market was down slightly today. The Fed lowered interest rates as expected. But Align Technology is who we're going to talk about today. I do have a video on this one already, I think. And we bought this one in the weekly pick service over on Patreon a while back. It wasn't too long ago. So, and I've actually owned it before. I bought it in the Cyclical Investors Club on Seeking Alpha back in March 2020, and it got more than a double, if I recall. I didn't capture this entire upside, but did really well with it in a short amount of time. Sold it. It looked kind of dumb to sell it at first when the market got crazy, but now that it's down 82% off the high, doesn't feel so dumb to have sold it. So these guys, as always, not individual investing advice, just how I analyze stocks, and I am long this one already with a small position, like 0.5% of a portfolio position. 0.5% to 1% is kind of what I'm usually talking about when I make these videos, unless I say otherwise. So these guys do like teeth aligners. So clear aligners, Invisalign is kind of their main brand. It looks like they have some scanners and digital services that like 3D scan your teeth and stuff like that too. But mostly I think about them as a tooth aligning business. Usually, if they can do it, is cheaper than kind of the traditional braces. Now, unfortunately, in my family, my kids needed, at least one of them needed like full braces, so I wasn't able to use the cheaper option. But so let's get into kind of the longer term performance here. So for the most part, this company's been, this dark green shaded area in the fast graph are their earnings. Let me take the price off for a second. We can see them a little bit better. So a little bit of a downturn during the Great Recession, which is probably not surprising. But once we came out of that, they had pretty steady growth. I mean, very steady growth actually, and very good growth, over 20% most years, all the way up until the pandemic hit, right? And then it was a little more difficult to go to the orthodontist. So one can imagine that they had a decline that year. So overall, earnings growth has been good over the past 20 years. Let's see what the price, even today, it's probably done pretty well. So even with an 82% decline, you would be up 1,100%, right? So it's a solidly growing business and a good business, but it just got crazy overvalued. Like at the peak, it was what, 75 PE. Even here, we were at an 85 PE. So sometimes the market just goes kind of nuts with stocks, as we see in the wider market right now with a lot of stocks. But eventually, earnings are what will determine the long-term stock price performance. So as long as you buy it at a reasonable valuation. So now we're at a situation where they are trading at a 13 PE, okay? Probably maybe even slightly lower than that if we use forward earnings. And, when the market's at, I don't even know what the wider market's at, like it's in the 20s, low 20s somewhere. And so much cheaper than the market. And honestly, my expectation is they can grow earnings at 7% a year. I didn't check this ahead of time, but I'm just curious what they think the S&P 500 is going to be growing at. So S&P 5, okay, a little bit faster. The market thinks 14 and 10, so maybe like 12% over the next couple of years. But still not crazy much faster. I suppose I could have looked at the valuation when I was there too. We'll see. Which at 25, basically a 25 PE. So almost twice as richly valued for the S&P 500 as for this company. So I'll look at the valuation here in just a second, like the actual including earnings growth using time until payback method. But I want to kind of talk about the story here, what I think is going on and what's gone on. So they had good growth. To me, this is kind of a borderline consumer discretionary service slash, I guess it's both. Obviously each person's different, but in general, there's going to be a group of people who are having their teeth aligned for more cosmetic reasons rather than like medical reasons. Probably maybe most people. So, and especially if you're talking about kind of the Invisalign rather than the more traditional braces, which are and other thing, surgery and stuff like that are used if you have like a really bad medical issue you're trying to take care of, right? So when people don't have very much disposable income, it makes sense that they would maybe delay doing things like this compared to when more people have more income, especially if they get like a big chunk of income that comes in and you're like, oh, I have this money. What are some things that we probably should have done or could have done or that we want to do that we can do now? And getting your teeth straightened, in my view, is one of those. So during COVID, once the stimulus money came out, a lot of people got a bit, especially people with kids, got a bunch of tax credits and things like that. And a lot of people went out and used it to get their teeth straightened, or even, older people who would have liked to get their teeth straightened but got some extra money may have gone out and did this. Well, they did do it because we can see that earnings went up 114% that year. So that's a boom, right? And that's what caused the stock price to go this high, because Wall Street is dumb. This is kind of dumb because you knew that with that little tiny amount of information that I just shared, you don't even have to know that much about the business really to understand that that's only going to last a couple years probably. Like that type of boom is only going to last a little while, and then it'll probably go back somewhat closer to the normal trend, provided everything else is normal, right? So that's what happened in 2022, right? It just basically reverted to the old trend that we had going leading up to there. And then in 2023, we're roughly looking at like let's just call it 8% growth, earnings growth per share, the past few years. Now, granted, leading into that, they were on more like a 20% growth per year track, but it also traded at a 50 PE at that point, and the PE now is down to 13, right? So the market is not pricing in 20% growth. So none of this, the point I'm really getting at here, because what I want to know is this like a long-term trend? Should we expect their earnings growth to just keep getting smaller and smaller until it goes negative and then never recovers back to like the old trend? And I think if you take a medium-term view, that's probably not the most likely outcome, and a lot of that's priced in already, especially compared to the rest of the market. So I think the market's right for the time being to say, look, 80% of people in the US don't have enough extra income right now with inflation and everything else to go out and get their teeth straightened, or at least they don't think they do, or that's not the top of their priority list, okay? 20% of people, probably according to just what people are spending on, that what's driving the economy still, because we aren't really in a recession yet, are doing a lot more of the spending, right? But that can change. Now, whether we have an actual recession before that changes and things get worse, I have no idea. But I do know a lot of it's like priced in. Like that's pretty cheap, and it wouldn't take, even if it takes 3 years or 4 years or 5 years, it wouldn't take a ton of earnings growth for the stock price to go significantly higher. Now, I don't know when that's going to happen, and there are risks that it might not happen. But compared to the rest of the market, where like all this optimism, and I mean, the rest of the market's priced more like back here, right? In terms of optimism in certain areas of the market, and this one isn't. So it's kind of hard to find, though. This is like a real kind of value investing. but with a high quality business. It's not, as far as I can tell, like a cigar butt. But one thing we'll want to watch out for is revenue growth, 3-year revenue growth, which is, it's weird because it's still coming off this peak, but eventually we'll want to see that form a bottom over the next year if we're not in a recession. If we're in a recession, then that explains it. You get more time to kind of see if the recession ends and they come out. But we saw from the Fed today that our interest rates are getting cut. They're probably going to get cut more, which is what I've been saying for a while. Not necessarily because they should be cut, but because that's what the president wants. So that should give some relief when it's easier to borrow money, and generally speaking, it gives people that are in debt more time to pay. It should help a little bit for the 80% of people that can't already afford stuff like this. I'm not saying they're going to go rushing out and doing it, but the direction is changing, and if that leaks through the economy over the next few years, maybe it can come out like it came out of, the Great Recession back in 2009-10. So this is going to require some patience for the people that are buying here. But I think it looks reasonably good. Like the chances are reasonably good. That it's also worth thinking that, unlike some things that if you delay, they kind of go away, like a new tech or something, there'll be more new tech that's different down the road, right? If you make something like that. With something like this, if things improve 4 years from now, this isn't going to fix itself. So it could be something that the more people delay it, the more they'll come in later in the future and do it once they have the money, if things improve, right? So a lot of this is going to depend, I think, on the macro economy getting better, and we might go have a recession first before it gets better. But it's kind of priced for a lot of that already. So I do think the downside risk is a lot less than a lot of other stocks in the stock market right now. So with all that said, let's get into the valuation. So there's basically two components when it comes to kind of figuring out what you want to pay for a steady earning business like this that doesn't have any cyclicality, that's not naturally very cyclical, like a semiconductor or something like that, like my Micron video. You want to project the earnings growth, and then you want to know what you're paying for those earnings, right? And that's basically the earnings yield and the earnings growth. So you saw on the fast graph, analysts are predicting like 8%, 7%, 8%. So I am using 7% as my earnings growth projection, which is, I think, pretty fair and conservative, and definitely not, it's under what analysts think, but it doesn't take into account recession. So, I just think it's fair. That's the best that I can come up with. If I use their historical earnings growth, it's much faster. Okay. So I'm being more conservative than what they've grown in the past. Maybe I could just look at it. I don't know. 17% over this time period, right? So I'm much more conservative. I'm not assuming they're going back to the good old days of super fast growth. Now the earnings yield is just the PE ratio inverted. So PE ratio is the price over the earnings, which I'm using $10.08. That comes from what they're expected to earn this year. And I'm pulling that forward, which isn't really much of a pull forward since we're almost there already. So instead of price over earnings, it's earnings over price, and it's expressed as a percentage, right? So the way I think about this is if I bought the whole business for $100, and it was just my business, I would earn $7.79 per year on my $100 investment if there was no growth, right? But I'm going to assume that there is growth, 7% growth. And I pull the first year forward when I do these just because it makes things easier, more consistent to calculate. So I'm going to pull forward the first year's worth of growth and see how long it would take me if I paid $100 for the business to earn $100 from the earnings of the business if they're growing 7% a year. So that's what the spreadsheet's designed to calculate. So first year, that's the earnings yield. First year, once we get that 7% growth in, you'd earn $8.33 on your $100. Next year, you'd earn $8.92, and you get to keep this money each year because, in theory, you own the business. And you want to see how long it would take you to earn your money back for the $100 that you paid for the business. I mean, it's pretty simple. But it does take a tiny bit of math because those earnings grow each year and compound. So when you do that, paying today's price of $129.44, it would take about 10 years to earn your money back. But this is actually right on the cusp. So if I just hit 129, like a couple instead of 129.44, it would take less than 10 years. It would take 9 years. So it's right on the border. That's usually where my buying level is, in between that 9-year and 10-year level. To put this in, I haven't double checked the S&P 500 lately, but the last few times I've checked, it's more like 15. It's like 50% longer, right? To earn your money back, assuming, the same things I assumed here, only for the index as a whole. So it's much more expensive than a line. And the real question is, over the next 10 years or so, can they grow 7% a year? I mean, it's worth considering. We have 3 to 4% inflation probability. I mean, 3% is almost guaranteed. I mean, I think 4% per year is potentially. So just if they can pass that cost on, they're probably halfway there to what I'm expecting them to be, what I'm estimating that they can grow their earnings at. And then because the PE is so low already, a small change in their earnings growth will rocket this stock higher. Because we can see how the market has treated it in the past. They had this down year here where it traded off when I bought it the last time, ironically. And once earnings jumped up, the stock jumped like I think it was 300%. Now, 400%. That's how great. Now, it was ridiculous that it ever got that high, so I wouldn't expect it to get that high. But let's say they did grow earnings 17%, like in a year, which if you're having a couple bad years in a row, you can kind of build up that business potentially, right? That comes back to you. Well, if you do that over the course of a year, you do have like a 200, and the market treats it like it's treated it on average during this time. Maybe we can lengthen this out a little bit more and see if it makes it more conservative. I don't know if it will or not. It actually makes earnings growth a little higher, but let's see. Now, granted, it's not as small as it used to be, but yeah, it's about the same. So it's the same, 250%. Now, I am not counting on 250% returns because I'm just too conservative for that. But the setup is pretty good. And the other good part about this is, if things do normalize, maybe they have a couple years where they grow earnings 10, 12% a year, when they weren't expecting to, and we avoid a recession or something like that. This is unlike Micron, which was my last video where we took some profits. This is one where you don't really have to take profits. You can just hold it over the long term and get pretty good returns when you buy something this cheap. Because you'll probably get some mean reversion. I could see it going, what is this? That's a 35 PE, but let's say it goes to like a 22 PE. Yeah, it's almost a double. I mean, I could see this doubling and then just kind of growing at 10% a year or whatever they are growing at. In like over the next like 5 years. But the timing of that is unknown, right? You never know when the market's going to kind of change its mind. You can see it kind of changes its mind back here for a little while before it reversed. Right, and that was a 100% gain, right? And it's lower now. So now in this case, the market decided it didn't like it. Again, market's kind of weird. This is probably just people trading when it's moving that much that fast. But we're getting down to the levels. I wouldn't be surprised if there's some short interest in this stock. I don't usually check that. But if they have a surprise, to the upside, then that you could get a short squeeze and get returns back out pretty quickly. That's when things like this bump right here happen, right? That's a 70% return in like a couple months, right? I don't know, March to October. So yeah, like 6 months or something. And I have a lot of stocks that do that. It's not unusual because this is the kind of situation where I try to buy. I also think on the downside from here, now if we have a recession, I think it could fall a lot still potentially if earnings go down. But the downside seems much more limited than a lot of the stocks in the market right now. The only thing that I think could be worrisome is if this allows like competition to come in or something like that. You know, that's just part of business, right? That's just businesses. That's the management's job to try to deal with that. And I go by what kind of history they've had most of the time, and they've had a very good history even during this sell-off. So, all right, there you go. Align Technologies. I have weekly picks over on Patreon for $25 a month. I have a free tier over on Patreon where I post a lot of videos. And so check those out. And the links will be down in the description. And I'll see everybody later.